Hi everyone, it's Jack about another video, and today I'm talking about a stock idea that I've had recently. It's a company that I've been following for a really long time, and that is Verizon. And for the last 5 years, or even further on than that, it's been a pretty poor stock to invest in. As high as $60 in 2019, 2020, now just $40. And late 2023, it was actually even lower in the 28-30 range. The last probably 3 months, if you'd have bought in around early October, probably been the best period to hold Verizon stock, maybe ever. It's currently trading a 6.6% dividend yield, and that's what I'm really interested in here. It's only an 8 trailing PE ratio. It's a decent valuation, even at nearly 52-week highs, and just provides a level of security. It's a defensive investment in what potentially will be a recessionary year going forward. A lot of uncertainty in the market, a lot of people predicting recessions. I don't hold much stock in people predicting recessions, but having an allocation to defensive stocks may be a wise thing to do. So I'll talk about its financial metrics, its financial summary from the most recent quarter, its cash flows, its debt load, how its dividend has progressed over time, and talk about its valuation and whether I think this is a buy, sell, or a hold. The most recent financials we have for this business were released at the end of Q3 2023. Total revenue was down 2.6% year over year. Now, this is absolutely not the end of the world. This is a very low growth business. 5% will be an absolutely excellent growth. Flat or down 2% is not the end of the world by any means, because the needle can be moved quite dramatically by the amount of wireless equipment they sell, which is variable at most times. Services and others was slightly down from $27.7 billion to $27.5 billion year over year. I don't think this is the end of the world. Tighter monetary environment, not the end of the world for me by any means. But the overall revenue, $34.2 billion down to $33.3 billion, is slightly more concerning. However, when you look at the total wireless service revenue, which is by far the biggest segment overall and the most important, it actually grew 2.9% year over year with strong quarter over quarter growth. We saw each a nice trend going forward. Adjusted EPS was down 7.6% year over year, but it's not really going to be affecting the dividend, and that's all I care about. They recorded $12.2 billion of adjusted EBITDA for the quarter. This is an incredibly cash generative business. 36.7% adjusted EBITDA margin. That is really, really strong. It was up 0.2% year over year. This result set is really what catalysed the growth of this business going forward. That 30% growth we've seen, as well as some defensive purchases. I think a lot of it came from a solid operating performance. Wireless retail post-paid phone gross adds 2.6 million. That's not the most important thing for me. What I want to see is better broadband net adds. That is really what's going to be moving the needle for this company going forward. As cable cutting and things like that reduce the size of the rest of the business, what we need to see is broadband net adds. The 4G, 5G and broadband segments of this business are by far the most important going forward. They're the infrastructure plays. They're what's going to give this company consistent revenue going forward, is providing that and servicing that. Broadband net adds, they had 34,000 in the most recent quarter. That was up significantly year over year. Really nice to see. The reason why Verizon has been, over the super long term, an excellent stock to hold, and why it continues to pay out really strong dividends, is because it has absolutely outstanding cash flows. $28.8 billion cash flow from operations in just the 9 months ending 2023, so that will surely be a significantly larger number in the full year. And even though they have significant capital expenditure, they've still generated just this year $14.6 billion in free cash flow, which is a non-GAAP measure, but however, comparing that to last year, which was also a non-GAAP measure, they only had $12.4 billion. That's a significant increase, a 20% increase there or thereabouts. Absolutely excellent. CapEx is coming down year over year, which is really nice to see. And cash flow for operations, which is, I suppose, if CapEx is coming down, then you would expect free cash flow to come up. But cash flow from operations also moving up nicely from $28.2 billion to $28.8 billion. Dividends paid increased slightly. This is not going to be an insane dividend growth stock by any means, because it's paying a nearly 7% dividend yield right now, and it has a very large debt pile which they're slowly bringing down. Of course, in a higher interest rate environment, that does make it a bit tougher for this business to pay off its debt. They don't tend to keep a lot of cash on the balance sheet. Cash is either going out in buybacks, going out in dividends, CapEx, or paying down the debt, which is exactly what this business should be doing. Should be staying away from expensive acquisitions like its main competitor AT&T was doing, which is why AT&T is in such a mess now. That's to spin off loads of things. That's to lower its dividend. I can't see that happening for Verizon in the near future. Internet and communications equipment is essentially key infrastructure that gives this business utility-like defensive qualities, and it also has an absolutely excellent margin profile. Nearly 59% gross margin, absolutely excellent for the industry. Not even that good for Verizon's historical comparisons, but right now, nearly 60% gross margin is very, very strong. Borderline software numbers, operating margin 22%. Again, absolutely excellent. Net margin of 15.5%, really, really impressive here, and a free cash flow margin around 10%. I really like that. Very strong for this industry, in my opinion. Return on equity percentage around 22.5%, very, very strong, and a return on invested capital around 6%. Not outstanding by any means, but sort of in the region of what I want for this sort of defensive investment. Debt-wise, that is clearly the problem with this business. Doesn't keep a lot of cash on the balance sheet, so the cash-to-debt ratio looks obviously ridiculous. Debt, while the debt pile is, in the 140 billion range, that is obviously an absolutely massive number. Compared to the market cap, it's actually not that massive. However, it's still a massive number. They need to work harder on paying down the debt, and that is where the dividend could come under pressure. But I think they make more than enough free cash flow to deal with this. They're currently paying about 60% of the free cash flow in dividends. They could easily, in my opinion, continue to pay down the debt at manageable levels, continue to pay off that interest, and be a fine investment for years to come. So debt is really the key question here. You can see the top graph is debt values in billions of dollars. Reached a high around $150 billion in 2021. Since then, they paid down debt of around $15 billion, still over $130 billion of debt. I think many people could argue this is a questionable dividend strategy at nearly 7% yield, given the capital demands of the business and the debt load. For me, the capital demand is manageable, as I've just mentioned. I don't think it's the end of the world. Personally, if I was in charge of Verizon, I would be reducing the dividend and trying to pay down the debt load. However, that's not the strategy going forward, and I'm quite happy to collect dividend payments on a relatively cheap business, in my opinion. In the last 10 years, that is really all you would have been doing, is collecting the dividend. The stock price, if you invested in around 2013, was around $30. 3 months ago, it was around $30. Right now, it's $40. You're sitting on not much of a gain. You've earned a decent amount in dividends. The yield in 2013 was around 4%. Right now, it's around 6.5%, which is obviously significantly better. The payout has gone up decently over time. It's probably about doubled in 10 years. That is a decent return, in my opinion. Other stocks that have better with better debt load, perhaps many of those don't have the same defensive qualities as this business, utility-like qualities. Also, I believe for this sort of dividend yield, this sort of dividend growth, and those defensive qualities, I think normally you would expect to pay a significant premium for a business like this. And I think because of the debt load, this business's price to earnings has just continued to come down over time, even compared with its peers. Price to earnings right now around 8 on a trailing basis, around 8 on a forward basis, because there's not going to be a whole lot of earnings growth here, but 7.8, slightly lower on a forward basis. The PEG ratio is almost unimportant here because I'm not expecting a ton of earning growth. Price of cash flow of around 4. All of these metrics are significantly below the 5-year averages of this business, which forward earnings, that's around 10.5. Price of cash flow, the 5-year average around 5.5. These are also significantly below market averages for an excellent dividend growth stock with good defensive properties in a potentially recessionary, tough monetary environment. I think this is a really, really nice play right now. And that really sums up my opinion on this business. I would have loved to have had the foresight to have been added into this business in October 2023 when it was at its lows. That being said, I still think it's a really nice investment now. It's still really cheap compared to the wider market and compared to its peers. Am I worried about the debt load? Yes, but this is an incredibly free cash flow generative business with utility-like qualities, in my opinion. It offers essential infrastructure to the modern society, and it is only going to continue to do this. It has high capex, but it makes more than enough free cash flow to continue servicing this, and seems to have a better capital allocation strategy than many of its peers. And I think the management are really showing the willingness to pay down debt going forward while trying to maintain the dividend, which is what many people are going to be primarily interested in here. They don't do a ton of share buybacks. It's primarily pay the dividend, pay down debt, pay capex, repeat. I'm quite happy with that at these prices. I think this could have decent returns in 2024, purely just from a value perspective. I think there could be decent multiple expansion once people realise the quality of this business. That being said, this is just my opinion. You should let me know your opinion down in the comments below. I'm of course not a financial advisor. You should take none of this as personal financial advice. You should do your own research and due diligence and form your own opinions on stocks before you buy them. Of course, for me, I think this is a buy for myself. Let me know what you think in the comments down below. I'll see you again next time.